Welcome to the Investor's Guide Budget Special. Good evening to those of you watching at home. We finally heard it, the Union Budget of 2015. It was called a landmark budget. It was called pragmatic. It was called practical. The market couldn't really make up its mind. It seesawed for most of the day. It ended the day about 0.5% or a little more than that from where it started. But that's not what we're going to talk about. This 1 hour is about you. What does this budget mean for your finances, for your investments? We're going to try and figure out all of that in the next 1 hour. Now, before we go any further and we try to figure out all of that, what I want to do is play this very quick report for you that puts together every announcement we heard this morning that has something to do with your money. Take a look.
A sovereign gold bond as an alternative to purchasing metal gold. For senior citizens, this limit will be increased to 30,000 from the existing 10,000. Is extension of benefits to the middle class taxpayers.
The finance minister announced many sops for savers in this budget. Here are the biggest takeaways for you. Now you have an additional deduction of 50,000 a year on contributions to the national pension system under Section 80 CCD. The limit on deduction for pension plans within Section 80C has been increased from 1 lakh to 1.5 lakh rupees. More importantly, you have the option of choosing between the EPF or the NPS for your mandatory pension deduction. There was a keen focus on health insurance as well.
Increase in limit of deduction of health insurance premium.
The deduction on health insurance premium has been raised from 15,000 to 25,000 rupees. The deduction limit on the account of specified diseases has been increased to 80,000 rupees for very senior citizens, who will also be able to deduct 30,000 rupees from their taxable income for healthcare treatments. The FM abolished wealth tax and imposed an additional 2% surcharge on the super rich in its place.
An additional 2% surcharge on the super rich with a taxable income of over rupees 1 crore.
To help mobilize our investments in gold, the government will also introduce a gold monetization scheme, sovereign gold bonds, and a new Indian gold coin with the Ashoka Chakra.
On developing the Indian gold coin which carries the Ashoka Chakra on its face.
Mutual fund investors will be a little disappointed with the increase in surcharge on dividend distribution from 10 to 12%. But as a boost to construction, the finance minister offered the real estate investment trusts of REITs some tax clarity and reintroduced the tax-free infrastructure bonds for rail and road companies. While the FM did not make a large allocation to infrastructure, low-cost and affordable housing found no mention in the budget.
All right, to figure out how all of that changes your life, and if at all you should be changing your investment concepts, I have a wonderful panel of guests, and these guests have been with me now for 7 years. A quick round of introductions. Pankaj Rastad, Shailesh Haribhakti, Anush Puri. Gentlemen, thank you so much for making time on what is, I know, a very, very busy day to be with us this evening. And of course, in our Delhi studio, Narendra Kumar, the CEO of Value Research, who's been holding our hand now for 7 years. Narendra, thank you for joining us. I want to quickly get a word in from all of you on what you thought of this budget. Shailesh, I'm going to start with you. This budget focused on two of your pet causes, I know. One is the NPS and the other one is health insurance. Are you happy that the two of them found so much space in that budget speech?
Very happy. So I think India has been so underserved so far as pensions are concerned that it was very high time that we dramatically altered the entire framework of pension. And I think this is long-term money. This will create the pool of permanent capital that India needs for financing infrastructure. Globally, no other way has investment in infrastructure gone in. Mm-hmm. Once we have large resources into a long-term pension fund, we can go ahead with infrastructure.
Pankaj, I want to bring you in here. A lot of retail investors at home are going to watch and say, oh, you know, maybe there wasn't too much for us in this budget because there weren't any big SOPs announced. The slabs were not changed at all. But if we look at it from a long-term perspective, from all of the things that were announced with a 4-year time horizon or a 5-year time horizon, long-term investors should be happy, shouldn't they?
I think every investor should be happy in this for a fact, simply because One should not keep expecting that every year I'm going to have a tax break. I mean, you can't make the tax zero over a period of time. God willing, someday it happen is fine. But the fact is that today, if you have a clarity, the first, I call it a vision document or a policy document, you have clarity for 3, 4, 5 years, how your country is going to shape, how economy is going to shape up. If economy does well, your investments are going to do very well. So you will have many more opportunities of investing your long-term savings and short-term savings, as Harish pointed out. And it's going to be good because they have multiple options also. In fact, this budget actually have thrown a couple of more options for them for investments. REITs is a beautiful example of that.
On that note, I know REITs will make you happy. We were waiting for that clarity now for a year, but no mention of smart cities, very little mention of urban development. And of course, in terms of low-cost housing, low-income housing, nothing at all. Are you disappointed?
So, the 2014 budget, if you look at it, was a lot real estate. And I remember coming to your show and saying is that it seemed to be like a real estate budget rather than the fiscal budget. This budget also started like that. So his first main sentence, if you look at it, was about the housing and 2 crore houses for the urban and 4 crore for the rural. But then it was a full stop. And if you look at the finer details in the document, it doesn't really say how they're going to propagate 2 crore urban houses and 4 crore rural housing, so there's been no incentive. We thought there may be an industry status given to affordable housing. It may be treated as a priority sector. There would be some fiscal financial benefits given to boost that. Nothing. Smart city in 2014 budget was a big thing. And since then, every week, if you look at it, the media was covering it twice at least a week. And there was no mention of that. So clearly from that perspective, disappointed, but we'll come to REITs a little bit later. I'm quite excited on that.
You know, unfortunately now all of the jokes happened on Twitter, and the fact that there was such a strong note about black money, there were a lot of real estate jokes that were made on Twitter about black money as well. I want to bring in Narendra Kumar here. Narendra, there was some mention of an increased surcharge there for, for mutual fund dividend distribution. But I want you to focus on something that I think is far more important. If we have the option to move our monthly employee provident fund deduction now to the NPS, I can invest long-term pensions in equity. How significant is this for a young investor, for a retail investor at this point?
No, I think it's extremely important. It is quite revolutionary, and I think only over a period of time people will appreciate what it means. Today it was a very funny situation that all the government employees were availing the fund management expertise of private players in terms of their money being managed, at least 50% of the money in equity managed by private sector pension fund managers. And all the private sector employees' money was managed by the government, the employee provident fund, and every year it was struggling to provide a return, and in a fairly opaque way. It's not a professional fund management exercise. So one is that. The other is for young employees, ability to get into something which is flexible, transparent, and structured as a transparent fund. So you get into the plan, and you are able to choose where you want your money to be, which asset class over and maybe choose the auto plan, and you are still on you are likely to be far more rewarding experience than being in a 8.5–9%. And I have my bigger worries about EPFO, that it's a fairly old scheme. It was structured at a time when market linked investments were looked upon differently. I don't think it was possible to have that, and it was considered to be even when our economy was closed. Today I think EPFO requires a very good auditing, eliminating the possibility of any kind of questionable thing happening over a period of time, because unless until it is it attains the structure of a mutual fund, and the subscribers are aware of what it stands for, what is its worth, what are the potential risks. I think it's only a matter of time that this is the only way. If we couldn't do that in the last 7–8 years, ever since the NPS was started, this is the only way to threaten it internally with a government-backed pension system.
The reason why I was also so excited about the panel that we have in the studio today is because Sharesh Haribhakti is an architect of the NPS scheme, and if Narendra has some reservations about how it's run. I know that on Twitter as well, we had a lot of investors who wrote back to us saying we don't know where to access this scheme. We don't know how to get it. We don't know what the returns are. So even if it's up as an option, and it seems like a great option, from the point of view of someone sitting at home, do you think that the government has done enough so far in terms of marketing, in terms of access, in terms of making it available to a regular investor?
I think the first thing the government did was they have a separate piece of legislation which took a little while to frame and formulate, but now it is in place. We have, as Narendra pointed out, very professional management at the NPS Trust. And the fact that private sector fund managers, but let's not forget that the three top managers are still State Bank, Life Insurance and UTI. There are four other private sector fund managers. But the systems, processes, controls, reporting, transparency, all of that has been achieved. And the way that the IT infrastructure has been created around it, we today feel confident that over the very long haul that we have to accept and manage people's money, there are enough strong systems and procedures not to create the kind of accident that Narendra expects might happen in some other circumstances.
All right, so for our viewers watching at home, what this basically means is the deduction that goes out of your salary every month that goes into PF, according to the finance minister, you will now have the option to move that to the NPS. Now, we still don't know a lot of the other rules and regulations that will come out over the next couple of months perhaps, but at least for now, that seems like a really positive move. What I want to do now is get a few voices in. We have some audience members in who have their questions. I understand the gentleman at the back has a question. Go ahead, sir.
Good evening, Narendra Kumar.
Go ahead.
I have just retired today, and I will have a fund of 80 lakhs rupees to be invested. Out of 80 lakhs, 50 lakhs I am reserving for my two children who will be getting married in a year or two. But for a period of a year or two, I would like to park this 50 lakh rupees fund for a short term, and it should be made available to me as and when it's required. Next 5 lakhs I will be keeping as an emergency fund with me. And remaining 25 lakhs, I would like to invest in such a way, as per your advice, whereby I can generate an income of 20,000 rupees per month. I am likely to get 30,000 rupees per month as a pension from my employer, and my monthly expenditure is likely to be around 50,000 per month. So I am running short of 20,000 rupees. How to generate 20,000 rupees income out of 25 lakh rupees fund?
All right, so Narendra, this is an interesting question. I want you to also bring in the fact that we now have a higher surcharge on dividend distribution on mutual funds. So for all of the fixed income investors who have been deriving a fixed income from their liquid funds or from their debt funds, how does this change their lives? And of course, his advice on what you'd like him to do with that investment.
No, one is the budget provision, and that is more likely to affect the companies because companies only invest, because what happened in the last budget, most individual investors will take a 3-year view when investing in fixed income fund. And when you invest for 3 years to derive the gains or the returns from a debt fund in the form of a capital gains to benefit from the indexation, then you don't choose the dividend plan. And you escape the, you escape the dividend distribution tax altogether. So for most normal investors who will take a long-term view and have fixed income fund as part of their allocation, or conservative investor who want to be part of the fixed income and have and that's their long-term allocation, I don't think they have to worry much. The only thing is that, yes, surcharge goes up by 2%. And for companies or, mid-sized companies who were doing, or for short-term parking vehicle, if an individual investor was looking at it, it doesn't affect the return much. And I would compare it, for most people as, investing in liquid fund is all more about, getting nothing and getting some return. And in that sense, deriving it in the form of dividend, I don't think, it will be beneficial for many people in the highest tax bracket, or there will not be any meaningful tax advantage, but the return itself will be the only charm for investing in such funds. So I don't think it changes substantially the dynamics of your preference for income funds or debt funds.
We're running out of time, so
about his personal goal, I would like.
I want you to very quickly go to the main question that he asked us, which is the 25 lakh rupees that he would like to invest and derive a monthly income from. Could you very quickly give him a plan on how you'd like him to do that?
I would like to, suggest him that he should, because his need for income on a regular basis is of a guaranteed nature. He has to rely on that. So he should split the two. Put money in senior citizen savings scheme, post office MIP to the extent possible, and see how much money, and if he should be able to derive 20,000 rupees out of those income, and remaining money should get into equity. And if, senior citizen savings scheme, the maximum he can invest is 15 lakh rupees. 4.5 lakh rupee is the maximum for an individual in the monthly income plan, and that will generate him without any kind of unpredictability about this. And remaining money should be in equity. But let me just remind him that this is by doing this, he will be running a risk of that his capital, most of his capital will be at work and will be generating income, and capital and the remaining money which will get into equity to supplement his income capital will not be enough to supplement the need for future income to be derived from his investment at a higher rate.
Okay, Narendra. So what we are also going to do is, if that advice helped you, we will email you a list of the funds and the portfolios that we recommend normally for someone your age. So you need to derive an income and also beat inflation over a period of time. But I am going to have to take another question. Go ahead. There's a young man over there with a question.
Good evening, everybody. This question is to everybody. Anybody can answer. I'm a hardcore believer of India growth story and have been investing in equities and mutual fund for the last 10 years. Looking at this current government's attitude and the policies towards reforms, can we expect a good growth, about 15 to 18% for the next 5 years?
A good growth, you mean in your equity investments, or
equity,
a good growth
mutual
of GDP?
fund, say a diversified equity.
All right, diversified equity. Pankaj, I'm going to come to you there. So, I mean, it's an ambitious, we're an ambitious people right now. And it did seem like the finance minister was optimistic. What sort of growth can we expect from our equity investments over the next 5 years?
So I think if we look at, it's a very optimistic thing, because just to really get him an answer, we need to look at, because India's problem will be actually sorted out only if there's a growth story. There are too many problems to be addressed. So the budget was very clearly focused on, people call it balanced and practical, pragmatic. It's a very growth-oriented budget. We don't have a paucity of time. I'm going to explain you that. If we look at the whole plan for 3 to 4, 5 years, it's actually talking from 8% to 10% growth. If overall economic growth is 8 to 10%, the markets will reflect this growth. And market will reflect if you have a very nice investments. If you don't pick up your stock by yourself, you pick up nice mutual fund or good investment schemes. Obviously, if market is economic growth is 8-9%, you will have a multiplier effect on that thing. So I think you should be happy sitting tight. If you're looking 5-7 years, pick up a good investment scheme and then sit tight on that.
A very quick question before we go into break. If I haven't started equity up till now, can I start now?
Absolutely, because it doesn't matter when the stock 100 has become 200, because the growth continues to grow. If your price become up, the growth doesn't start. So never get. Most people get caught, oh my God, this stock was 100, now it's become 200. The company has not stopped working. If a company, as far as a good company, good management, good products, and they continue to grow at 15-20%, that 15-20% growth will get reflected back on their stock prices. So never get bothered with NAV, never get bothered with the stock price.
All right, so that's an interesting thing to remember, that the market hasn't shut down. We'll open again on Monday, and it's going to continue for a very long period of time. And this country has plenty of growth to offer, those of us who haven't started yet. So if you're investing in equity, Monday is as good a time as any. Welcome back. You're watching the Investor's Guide Budget Special episode. Thank you for staying with us. Our audience is still here, and we have a lot of questions for our panel of guests. And as you know, I'm always very partial to female investors. We have a woman investor in the audience. Go ahead, tell us your question.
Hello everyone. My question is to the entire panel. I'd like to ask about gold bond. Like, how is it different from gold mutual funds? And secondly, how will it offer a better rate of investment, return on investment compared to gold jewelry? As a woman, what should I prefer first?
So it's almost typical that the woman in the audience will ask about gold. Pankaj, do you want to take that? How will it be different from the average gold mutual fund?
It will be very good than buying a jewelry, unless you want to wear a jewelry. But otherwise, you suffer making charges, you suffer breaking charges. It actually is a very good initiative, because if you're not using a gold, I might as well use in a paper form. Otherwise, every time you import a gold, you're importing your pressure on currency, your current account deficit keeps going up. So out of 800 to 1,000 ton gold what we import, 300 to 350 tons is basically for investment purposes. If it's only for an investment purpose, please go and buy a gold bond. It is going to reflect exactly underlying what the gold prices are there. I think government has done a brilliant job at doing this thing. You don't need to, it's security issue is not there. You don't need to go and purity issue is not there. You don't need to worry about if I bought some jewelry, it's going to break up, what's going to cost. If you want to wear it, partly you wear it. But if you don't want to wear it, gold bond is an option. Now, you want to buy a gold bond or a fund, they're ultimately going to reflect the same thing.
Will the gold bond have some sort of interest rate on it, or will it just be the reflective value of gold?
It's actually be a reflected value of a gold. You buy investment only for buying a gold. So interest rate, how are you going to get interest rate? It's going to be a reflect of the price, which are going to move up and down. So I think it's going to be same. Gold investments in mutual funds are of two nature. One is exactly like this. One, people actually invest into gold company, which are not so much in India right now. So as the stock prices go up and down, you make up and down in that stuff. But if this is going to be exactly, instead of buying a physical gold, and worry about where to keep it, somebody take away, or purity, non-purity. This is a paperless thing. You can want the money, next morning you can go and you can get the money back. So brilliant if you don't want to wear it.
So wearing a gold
Thanks
bond
a
would
lot,
be
yeah,
slightly awkward. Also, if you're going to buy a gold ETF, you need a demat account. It's unlikely you'll need a demat account for a bond, so that might actually work out better. So you have to choose based on access as well. There is a young man in the front. Go ahead.
Yeah, very good evening. My name is Gautam Shah. I'm a certified financial planner. I'm practicing. I have a question regarding NPS. Since this budget has shown a lot of importance towards NPS, if you see the previous government's budget, they had, they promised that if DTC is ruled out, pension schemes will be tax-free. Still, the emphasis is more towards pension schemes, but with a horizon of long-term investments for next 20-30 years. Still, investors are not ready because of the tax implementations. Even though you are from your end, the emphasis is more on pension schemes. Also,
What is your question exactly?
Still, you are emphasizing more on pension schemes, but investors are not likely to come into NPS because of the tax implementations. Annuity in India are taxable, whatever you start with that. So even if you encourage more, there will be a less of interest from investors.
No, but so therefore this particular provision in the current budget is very interesting. What happens is that by your investing the extra 50,000 in NPS, you get a straight deduction against your, so at the time that you are entering, you have earned that becomes your startup capital or additional advantage, if you like. You will never have a situation where you will have complete tax elimination, because the whole basis of the DTC, which of course has been integrated into the law now, was that we don't want a system which is ridden with exemptions and eliminations. We want a simple system where there's an average rate of tax which everybody pays in an honest way, and that's the end of the story. If we want to be good corporate citizens, we should be ready to make that little contribution by way of paying the tax on a progressive basis. Let me say this. The rates of tax in India today are globally competitive. So I don't see any situation in which I would like to recommend to the government that please eliminate all taxes on pension, only then pension will be successful.
I want to bring in another question. There's a young man in the front who has a question on taxation, right?
It is actually related. There was a talk about making NPS EEE, that is exempt on withdrawal, but I think you probably are indicating that it may not happen.
It won't. It can't, because you look at it today, the sum total of money within the NPS framework today is close to 75,000 crores. That is expected to gallop by more than 100,000 crores every year. And with this budget's provision, it may gallop even faster. So we will have a situation where the large mass of the people's savings will be in this permanent capital spewing fund, which will fund and finance infrastructure. It's potential to do that. Now, when you have those kind of large situations which are embedded in the NPS, you can't expect that the government will give up all its tax revenue.
In fact, I'm going to bring in Narendra here. Narendra, we've been talking about the possibility of a retirement mutual fund, which will encourage people to invest in an equity mutual fund that I can hold until retirement, which would have possibly been more tax efficient because equity is tax-free after a year. Are you disappointed we didn't see that come up in the budget? And do you think that this form of the NPS is a good enough replacement for that retirement-linked mutual fund?
Yes, that was there was a basis for that expectation. SEBI in the last SEBI last proposed something to the government, which was the long-term plan for mutual fund, and that was very much a part of it. The problem of NPS is that yes, it is little inefficient. Also, it gives limited choice to investors. Particularly the large amount of money which has come into NPS from the central government and state government employees. It is not managed the way it was initially planned. It has become a pooled account with a fixed allocation, and now finding its way and it's managed by 3 fund managers, the public sector fund managers, pension fund managers. So in that sense, the initial architecture of NPS was that investors will choose, and investors will decide on their allocation, choose their manager, and get their money managed. And also, there is an arbitrage here. So yes, it is a missed opportunity. It is little disappointing, because the advantage of a mutual fund linked retirement plan was the way it was designed is that all the mutual funds today on offer, they have a dividend plan, they have a growth plan, and they will also have a retirement plan. Once you put your money, and that would have been a discretionary savings choice. And at some point it could have become, giving investors a choice creates, there would have been a wider market, because mutual funds will be interested in selling them. They will have greater flexibility. Also,
Yes.
at a certain consumer level, mutual funds are also brands.
Right.
If you get an opportunity to invest in a fund which you know about, and you are putting your money with the essential lock-in period, that is all that a pension fund is.
Unfortunately,
With built-in, competitiveness, portability. So yes, it is a disappointing thing, but
Yes.
I would say that NPS, who knows, the tax bit which one of the one questioner came by, I don't think that is as much of an issue. The large number of people who are going to be part of NPS, if that money has to be annuitized, and 40% of the money, if you actually take it out gradually, I don't think there will be as much of a tax implication.
we have a lot of questions from our audience, and one of the questions that I repeatedly received on Twitter right through the day was about REITs, real estate mutual fund that will be able to pay out a rental income. So right now, as it stands, commercial property will be bought by the fund, rented out to various offices, and that rental income will be distributed among investors. Is that the way it is? And we got some clarity today. Tell us what this means, Anuj, and more importantly, how long will it be before we get access to these funds?
So fair, it was a very good thing. And we'd been waiting for it for the last 12 months, because REITs were really announced in the last budget. And there were a couple of tax clarifications that were required, and we thought perhaps during the year that the clarifications may come through, and it did not, and finally they came in through today. So just to answer your last question first, it is now a reality. So we are going to see at least 2 REITs come in within this calendar year itself, because there are several developers who are retrading, and I feel is that there will be at least 2 that are going to come up this year. The potential to raise capital in this is about $8 to $10 billion. So it's quite a big market that can be created. And what it will help is bring in the retail investors to be able to play into the real estate game. Because if you look at it today,
Give me an indicative return if a retail investor enters one of the 2 REITs you're talking about. What sort of return are we talking about here?
So on the core return, you're going to get between 6.5% to 7.5%. And then on top of that is going to be the capital appreciation, which my view is about 4% that you're going to get, between 4 to 5 or 5.5%.
6.5% to 8% on commercial property. Isn't that ambitious right now, where we are in the market?
No, not at all. Because today, if you look at it, that where the developers are and where they are selling it to the foreign private equity guys are between 9.5% to 10%. So they're selling it at 9.5% to 10%. So I'm being very realistic that the REIT in the hand of the consumer will at least get that as a core return, and on top of it you'll have the capital appreciation. So in all, I believe it's going to be sort of 13 to 14% you're going to get it. And if you don't get that kind of return over a period of time, then it'll be very difficult to excite the retail investor. The second is you're going to get foreign institutional funds come in, and that's the big thing that we're waiting for, where there's a lot of capital that is parked outside, and they're really wanting to come into this safe core investment market where they can come in and buy into the REIT fund. What it'll also do is deleverage a lot of the balance sheet of the developers, because at this moment in time, if you look at it, there's a huge amount of commercial real estate sitting on a number of either listed or non-listed developers, and it'll free that debt up, which will then get paid largely to the PSUs banks. And that will free up the cash flow in the PSU to further go out and give debt to some of the residential projects. So actually the cycle will start to move.
All right. So my advice to retail investors is don't experiment. We don't want real estate developers deleveraging their balance sheets with our hard-earned money. Let's wait for someone else to take the risk. About a year from now, when it's proved it's 8% return, then maybe we'll try it out.
Yes. Fair, you're right. I think is in the first go, you're actually going to see a lot of the institutional investors who are going to come in because they played this market.
Okay.
They played in mature markets. They will be the first ones who will come in. You're absolutely right. I think it'll be only a sliver of investors, and that will also be high net worth individuals who are going to come in the first phase.
All right. Speaking of retail investors, you have a question. Go ahead. Tell us your question.
Good evening, sir. My name is Rudra. I'm 24-year-old. And as a first-time investor, should I invest in tax-free bonds or gold? As I have started earning just now. So
okay, so I want to ask you one more question. When you say tax-free bonds or gold, is there a reason why you're not considering an equity mutual fund or something slightly more linked to the stock market?
Gold is like sir said before, and tax-free because I want to know something happened just now about that. So I'm curious to know about that. Tax-free bonds, what are tax-free bonds, and how to deal with it as a first-time investor.
I don't know if I should blame you for encouraging gold at this point because I don't encourage gold at all. Unless you want to wear something pretty, it doesn't make sense.
Absolutely.
But which of you wants to bite the bullet here? Gold, tax-free bonds, these are the two options she's
I think
considering.
sorry, I'm just taking this mic over here, but I get very excited when a young person come and ask me this kind of a question. I think at your age, we'll explain you what does the gold mean, what is tax-free bond mean, for your only administrative understanding purposes. But for your age, when you have a long way to go, you have to look at an investment which is going to give you a right return, beating inflation, and ability to go and take a risk because you're very young, 24 years old. So I think the best option for you would be to look at an asset, put a diversified asset, but equity should be one of the predominant assets in your portfolio. And tax-free bonds are like a normal bond. You pay money and you get interest. In this case, you get a tax-free interest. You don't have to pay a tax on it. And as I said, gold, if you want to wear a jewelry to look good, you wear it, but not for investments.
All right. In fact, what I'm going to do is I'm going to bring in Narendra Kumar because Narendra, we normally recommend that a first-time investor who's doing equity mutual funds for the first time in her life starts small, maybe use a balanced fund because then she mixes the two. Would you recommend a couple of balanced funds for a first-time investor?
Yes, absolutely. If you have never experienced, market-linked investment, then balanced fund is the way to go. But, before that, if she is going to be paying taxes in the first year itself, tax saved is money earned. So maybe it might be worthwhile to consider a tax-saving fund to begin with. The advantage of a tax-saving fund is also somewhat similar to that. She can choose a conservative one so that it's not very volatile, because once you invest in a tax-saving fund, you get stuck for 3 years. That's the minimum lock-in period applicable on a tax-saving investment. So your experience is unlikely to be very disappointing once your holding period is 3 years and more. So if you're going to be paying taxes depending on your income, choose a conservative tax-saving fund. If it is not so, then get started with a balanced fund.
Narendra, I'm going to interrupt you there. Quickly give me one conservative tax-saving fund that she can use.
I'll give you two. Magnum Balanced and Franklin Tax Shield, they're large cap tax-saving fund. Balanced fund, I would say ICICI Prudential Balanced Advantage, a conservative fund. Likewise, Tata Balanced are the two conservative balanced funds.
All right, thank you, Narendra. In fact, I'm going to take one more question before we go into break. The young man at the back, go ahead.
Yeah, good evening all. So taxes unfortunately obviously did not become zero, but service tax has gone up, so which means we will be spending more. So for a spendthrift salaried professional like me who just about tries to get his investments right, which is that one sweet spot or one investment scheme from today's speech which you think we must really focus on and as investors really look at positively?
Shailesh, I'm going to come to you with this. We have so many options. It's a crowded space, really, to pick one. And for a young man who likes to spend his money, if he can spare something every month.
So I've quickly analyzed him as a risk taker. And if I go with that assumption that you are a risk taker, then I would say you should look at an equity mutual fund. Of course, I would not recommend that you go in and punt on a particular equity, but go into an equity mutual fund. And go for people who have a track record, a institutional loyalty, a name, a brand behind it, and then make sure that you stay with it for a long period.
I know Pankaj has to run and catch a flight, but I'm going to ask you to very quickly come in here. A lot of young people rely on fixed income, PPF, things like that, because they believe the market is risky. So if you're talking about a 24-year-old or a 25-year-old who's looking at a tax-saving mutual fund right now, like Narendra also recommended, why should they start now? Why should they use an SIP? Why should they do it month on month and not wait till the end of February?
Yeah, but I think it's more risky if you don't reach your financial objective. That's a bigger risk. You realize after 5 years, my 100 should have become, say, 500 or 700. It's not become. And that's the time you need that money. So it's much better to take a risk which you know over a period of time actually gets smoothened out. So I would say that discipline, I say in this place, every time I come, every discipline, do a light asset allocation and keep investing in long-term assets like equity assets. Through mutual fund, if you don't know how to go and pick up your stocks directly. So it's not a risky to invest. It is more risky if you don't invest.
Welcome back. You're watching the Investor's Guide Budget Special. This really is the fastest 1 hour of my year. The time's just slipping away from us, but I'm going to try and answer as many questions as we can for the members of our audience. I believe the gentleman in the front has a question. Go ahead.
Good evening to all. My name is Samir Naik. I'm an industrial marketing consultant. I have a question on infrastructure, which we have been hearing for last so many years with previous government, and this government has come on infrastructure in a more vigorous way. From day one, the present government has been talking of infrastructure development. I, as an investor, have not had so good experience for the last 5 years, but should I continue with my investments in infrastructure equity? And if so, can I still increase my investments in equity? And with what time perspective?
Do you have an investment in direct equity? Have you bought stocks or is it
equity,
mutual funds?
Direct equity.
In direct equity. And do you want to know if you should add to that particular sector? I know that Narendra believes that we should just use equity diversified mutual funds and not take sector specific spots like that. But Shailesh, what would you recommend?
I think just to be helpful to you, sir, I would say that if you are already invested in an infrastructure company which is still performing and has not breached the normal acceptable levels of debt, indebtedness, then you should stay with your investment. You should not do too much if it's a performing investment from every perspective. But if it is not, then it is better that you take out your investment and make sure that you get into a diversified situation. So you will have to do a very clear assessment of the infrastructure company you're invested in.
I want to bring in Anuj here on a slightly different note, but I'm picking up from that infrastructure theme. Over the past years, we've talked about the fact that every time the finance minister says new roads, new access, new rail lines and things like that, you open up land to build houses and the prices of property come down. That's never happened. The price of property hasn't come down. And this time we didn't even have any of those announcements. So for those people who are watching at home saying, interest rates will come down, but the price of property doesn't seem to make itself accessible to us anymore. We can't afford to buy in our cities. Is there any hope at all in that tunnel right now?
Right, so my thought is that there's been a lot of announcements on the infrastructure, but when it's coming to implementation, it's not happening at the same pace. And that's why the land prices haven't come down. So the demand has gone in greater than the pace of implementation of the infrastructure. So whilst every budget, not only the last budget, but the UPA 10-year budget as well, there were a lot of announcement of investment, but really we did not see that implemented. If it was implemented the way that those were announced and within the schedule, then certainly you would have opened a lot more land parcels and hopefully the prices would have come down. So that hasn't happened, and that's the reason why the prices haven't come down.
And they're not going to in the near future either.
Well, unless they implement it.
Okay.
Unless that implementation happens. And I think this time I was a lot more positive on two accounts. One, it was 70,000 crores, plus he said is that there's going to be more money that is going to get allocated. But where the other sentence that he made was, he recognizes that public-private partnership hasn't worked in its true earnest, and that the government needs to take more risk on their balance sheet because there is an imbalance in risk, which I thought was a bold statement to make.
I want to very quickly ask you this. If I'm looking to buy a house right now to live in, this is not an investment, to live in, should I go ahead and cut that deal now? Should I wait until some of this actually plays out? I want a very quick yes or no answer. What would you recommend we do?
I think is that we're really at the bottom of the market at this moment in time, and the bottom of the market will remain at least for 6 more months. So I wouldn't say is today. Today to 6 months it will. At where the cost of construction is today, there is no way that the prices can sustain it at that level. The prices will continue to go up. unless there is a huge amount of infrastructure that's put in play, which I think will take 3 to 5 years for that infrastructure to really come in and play on the prices.
All right, so I want to take another question. You have a question at the back. Go ahead.
Good evening, Narendra Kumar. I am Avdesh Vishwakarma, 30 years old, and my monthly saving is around 10,000. So I would like to build my retirement corpus. So can you suggest me some fund, because I have chosen mutual fund over NPS.
So he seems very proud of the fact that he's chosen a mutual fund over an NPS, Narendra. But could you tell him what sort of mutual funds he should be using?
No, but that's all right. Basically, any investment which you make for your retirement is your pension plan. And if it happens to be NPS for a tax reason, then it's a different story altogether. Or if it happens to be the Swavalamban scheme, which is going to be renamed as the Atal Pension Yojana or whatever, then it's a different issue altogether. But I think any money which you which you invest, which is targeted to meet your retirement needs or for your pension, and you are disciplined about it, is your pension plan, irrespective of whatever it's called. So I would urge you that if you are likely to pay taxes, if you choose tax saving fund and be at it, don't get distracted, and you are disciplined about your investment, that's a great way to go. It not only gets you the tax break when you invest, it accumulates in a manner that without any tax implication, and when you want to take it out, because the underlying investment is equity and you are investing for the long term, all your gains will be tax free. So you get everything there. That's your pension plan, and you can do partial withdrawal anytime with a good part of your money after 3 years. With this kind of pension plan, which is a self-devised pension plan, which gets you the tax break, all it requires is your self-discipline.
All right, so that's the most important ingredient. If you're going to make that very, very efficient decision, you have to be able to stay disciplined. I have 2 minutes for one last question. Go ahead.
Good evening, everyone. My question is with Hari Bhakti, sir. Regarding the introduction of more panel provision on black money, like imprisonment of 10 years and all this, but there is nothing on tax administrative reforms. So as a practicing chartered accountant, on behalf of my clients, I want to ask, will it be more harassing or...
It doesn't matter how we try to put together a panel of retail investors. There's always one CA who manages to slip in.
No, but I think to give you a very straight answer to your question, the finance minister said in his budget speech that the recommendations for the internal administrative reforms of the tax department are in a very advanced stage of implementation. And if those get implemented, I can tell you that the reliance of the tax department on the tax information network will go up. There will be a little better automaticity to particularly the refunds, which is what in practice chartered accountants really struggle with. The clients are always hollering about why the refunds have not come. And so with all of this IT-enabled process that I see is likely to get implemented, let us remember that the chief cause of tax increase was tax information network.
So,
and now there's big emphasis on that.
I'm going to interrupt you here because I only have a minute and a half left. And I very quickly want, one sentence advice from each of you, a takeaway from this budget, what each retail investor should do. It could be as simple as write things down. Go ahead.
Well, my advice to retail investors would be look very carefully for equity. This is the time to move to equity. The country is on a growth path. We should all be proud to be part of this country.
All right, equity. Anuj?
It'll be the first time that the retail investors will really get a chance to play in the real estate on the public market, other than the IPOs that had happened with the developer community. But as you rightly said, Faya, my guess is that it'll be once the foreign financial institutions and the Indian financial institutions start to play, that's when the retail investors will come in. But it's a great move for them to play in real estate now.
The operative word there is play. This should be play money, not hard-earned life savings. Narendra, one very quick word of advice for retail investors who are watching.
One advice which I would like to give in the context of this budget, that if you have been making your EPF contribution and that is the only money that you are able to save, then seriously consider moving that money to the NPS and get to the highest equity plan. You will otherwise miss out on all the upside and ability to beat inflation.
All right, so equity, that is the advice that you're getting, but discipline and managing to stay on track. That's my advice to you as well. It's a wrap on Investors Guide Budget Special. Remember, we're here through the year. For any questions you have, email IDs on your screen, Twitter handles are on your screen. Gentlemen, thank you so much for spending time with us. We will rely on you right through the year to answer our questions. Thank you so much for watching.